Okay, so welcome to the last bit of this lesson in this section of the course. Right now, we're going to talk a little bit more on money management strategies. Okay, so now you have the strategies, you know how to analyze the market, you know when to buy or sell and when to exit. You also know when to stay away from the market, which is during the choppy markets. All of the above is very important for you to know as a trader, but you're still missing the key, which is money management plan. So the most important thing most traders don't talk about a lot is money management. And this is what makes a difference between traders. So difference between winners that are made here, day and night winners. It separates successful traders from losers. If you are trading without a money management plan, you are just wasting your time and money. So nothing is basically going to work for you. Even if you have the most powerful trading system in the world, most traders spend months and years looking for the right system and they focus on how to enter the market but forget about money management skills, which is the most important skill for a trader. Money management aspect number 1, so position sizing. One of the most important component of money management is position sizing. So what I mean by position sizing is the number of lots you are risking per trade. So remember, we spoke a lot about trades, about lot sizes in the beginning of the course. All brokers by now offer mini lots as a default position size. The smallest value of a mini is approximately $1 US. There are brokers that offer 10 cents for a mini lot, which represent an opportunity for traders who don't have bigger accounts. They can begin with as little as $300 US and they still have a chance to grow it. When it becomes to position sizing, you should think in terms of dollars instead of pips. So let's say you're trading 2 mini lots of Euro USD. If the market moves in your favor, you will win an amount equal to $2 per pip. If you're able to catch 30 pips, you will make a profit of $60. So let's say you put 50 pips stop loss and 100 pips is your target for your profit, as your profit target or TP or take profit. This means if the market hits your stop loss, you will lose 50 pips, which is $50 US. And if the market hits the profit target, you will make $100. The size of a position depends on whether you have a standard or mini account and how many lots you are trading, how many lots you're going to be opening for this trade. This information is important to you because this will help you know how much money you can risk, how much money to risk on each trade. So this brings us to the risk and reward ratio. The risk to reward ratio concept is what will make you a winner in the long run. So before you enter any trade, you have to know how much money you will win if the market goes in your favor and how much money you will lose if the market goes against you. The best tip that I can give you right now is to never enter a trade which the profit is less than the amount of money you are willing to risk. So for example, if you risk $100, your profit target should be at least $200. This is a risk to reward ratio of 1:2. So suppose you took 10 trades with 1:2 risk to reward ratio. In every trade you risk $100, and then let's say the outcome is that you won 5 trades and you lost 5 trades. So you will lose $500, but you will make $1,000. So the benefits is, so at the end of the day you have a $500 profit. This just shows you that you don't have to win all your trades to become a successful trader. Only if you can take the advantage of this risk to reward ratio concept, you will be profitable. So now let's move on to the importance of stop loss. A protective stop loss is an order to exit a long or short position when the price moves against you to a specified price. So stop loss ensures against large loss and has to be used in one way. An initial stop loss can be placed with your order on the trading platform. The trade will close automatically when the stop loss is hit. This type of stop loss will allow you to execute your trade and go spend time with your family or friends instead of sitting right in front of your computer following the market with your eyes the whole day. It will help you to trade out of your emotions because you know how much money you will lose if the market didn't go in your direction. Okay, so one of the things that most traders use is what we call the mental stop loss. So they don't actually place the stop loss because they think that the broker will hit their stop loss, which is not true. So the reason behind using mental stop is the human psychology. Humans hate losing money. We all do, which is why we are going through this money management strategies. And if you don't accept losing money as part of the game, you will never make money in this market. So please don't use a mental stop loss because you can't control the market and you can never know what to expect. When you enter a trade, calculate how much money you may win and how much money you may lose. Place your stop loss, order and profit target and forget about the trade. Let the market do the judging, whether you are right or wrong, and then you take it from there. So in this business, you can either make money or lose it. So just like any other business, it's very risky. It's either you're gonna make profit, or you're gonna break even, or you're gonna lose your money, and the opportunity is gonna pass you. But you should start trading with the amount that you can afford to lose. Don't ever risk big money you are not willing to lose, or borrow money thinking you will pay it back with profits. Trading is all about emotions. If you trade and you are afraid to lose your trading account, you will fail in this business. You will be controlled by emotions instead of sticking to your trading plan that we made earlier in the course, as well as following the strategies that we have shown you throughout this course. This will affect your trading decisions negatively. You will not allow your trading strategy, and you will fail. The best is to start small, try to get as much experience as you can. Also, remember, guys, you have the opportunity to trade with a demo. So when it comes to demo trading, we actually advise you to trade with the amount of money that you will want to fund your account with, and treat it like a real account, because remember, there's no difference between a demo account and a real account. It's basically on the same platform. You will be using the same MT4 platform that you're using, whether it's a demo or a real account. So you can say that there's a difference between demo and real account. The difference is basically behind your psychology, behind your thinking. So you have to treat your demo account as if it's the money that you have actually put in. So the only thing that is, obviously, you cannot withdraw the profits, which actually hurts, but otherwise is the best way to learn in this market and practice your strategy until you have perfected your skills and you have built a lot of confidence. So only find a demo account with the amount of money that you will be able to put in your real account, and then treat it as a real account, the way you'll be able to treat your account. So build your account slowly, because this is how successful traders become successful.